All right, good morning, everyone. It is 8:14 on the morning of July 18th, 2022, and this is my pre-market strategy session. Basically, today my bias is to the upside, and that's going to be a counter trend bias for me. I'll get to that in a few moments. First, though, I want to go over the 10-year yield minus the 2-year yield, which has inverted. Right now, you can get 233 basis points more for your money if you invest in a 2-year bond, or 2-year, was that note? See, there's notes, bills, and bonds. 2-year, this is a bill, I believe. 2-year, no, that's a note. I don't know. The short-term ones are the ones that are notes and bills, and bonds are 5 years or greater. And I've forgotten what 2 years classified, whether it's a note or a bill. I think it's a note because I don't remember. One of them, money, the dollar is a bill, I believe. Anyway, it could be a note. I don't remember. And so in any case, the 10-year and the 2-year is inverted. The yields are inverted. So you can get more money for putting your money away. You can get more return for putting your money into a 2-year than you can for a 10-year, which is backwards. It's supposed to be the other way around. And these things have a high probability of forecasting recession. And what I want to point out is that it's not actually until after, in historical reference here, and I'm going to start with 2001, and I'll go back to the 89 too, but I don't know if the SPY was around from 89. I don't know how accurate my data is for the SPX, but I'll go back and look at it. Definitely, though, the 2007-2008 housing crash was forecast, and the market actually didn't start to go down until the yield curve began to correct, essentially. You can see here the yield curve, the 10 and 2 spread went negative, and it really hung around the negative area here. You could call it from February 1, 06 to April 07. That's a little bit more, that's 14 months roughly. And then as the yield curve began to normalize again, that's when we got all of the turmoil on the market. And that's this circled green region right here. So I'll go take a look at from basically June 1 of 2007 on the SPY, and let's see what that looked like here real quick. So June 1 of 2007 is right there. And so, the market got, it didn't start right then. So when the yield curve began to, I guess you could say, normalize, the SPY didn't, or the S&P didn't react until, let's see, 1, 2, 3, 4, basically 5 or 6 months afterward. It kind of did this dip down and recovery, and then really started to roll over. So let's go back here and look at the 10-year minus the 2-year. I'll pull up June 1. Here's June 1. Make that line a little bit bigger, a little bit easier to see. You can see here that the yield curve began to normalize, and after 1, 2, 3, 4, 5, basically 5 months of the yield curve normalizing is when the broader market began to experience a downturn. Okay, so then now let's go to the next one here. The next one is the 2019. Actually, let's go back to 2001 here real quick. So this represents the dot-com bubble essentially, and here we have January of 2001. Right here, there's January of 2001. Now let's go take a look at the SPY, what the SPY was doing in January of 2001. Okay, so here's January of 2001. So it just kind of started to correct. The SPY started selling off prior to, in this case, 4 months prior to the yield curve normalizing, getting back above zero. The SPY started rolling over, and it looked probably like a pretty normal correction up until it really started to. It took a year, a little bit more than a year, actually 2 years. This was drawn out over 2 years. This move right here. This is January '01. I'm sorry. Well, actually, it was close to 2 years. Yeah, and then this over here, the bottoming area, yeah, is roughly between October of '02 and March of '03. So wherever you want to call, kind of the bottom, and technically, you can't get too accurate with any of this stuff, really. It's all kind of ballpark statistics. So the perfect timing is really, really difficult to do. That way, really, the best way to trade a turn like this is to average in. So I imagine what I'll probably look for the turnaround is for rates to go, for it to hit the market again, for the market to really kind of sell off again. I'll wait for the 10-year and the 2-year yield to reinvert, I guess you could say, normalize. Then here's, let's see, September of 2019. Let's look at the SPY for September of 2019. So September of 2019, it started to normalize again and then rolled over hard. This is somewhat of an anomalous. I mean, this was the beginning of the pandemic right in here, so kind of hard to say exactly what happened right in there. And then let's see, what was the other one? The other one was from the 80s, maybe? This is the 87 or the... Yeah, all right, so let's see. Let's say that it started to normalize. So here it went below zero, made a run back up and bobbled around for a long time right there. I mean, this lasted from 88 to, let's see, was that December of 88 to, so it's basically 89 to, and then it really started to normalize again in July of 1990. So December 88, so 89, so a little bit more than a year and a half. All right, let's go check out what July 1990 looked like on the SPY, if the SPY goes back that far. No, the SPY doesn't go back that far. The SPY was started in 1993. The SPY is the proxy for the S&P. So let's go over to the, where's my daily? There it is. Risk range plays. Let's go over to the SPX and see what it did in July of 1990. Okay, that's June, July. All right, so here in July of 1990, let's see what kind of range we're working with here. So from the top here to the bottom, 20.36% correction, technically bear market, but then turned right around and went right back up as the yield curve started to normalize again. So I imagine, in leading up to all of these, pretty much all throughout these times right here, while the yield curve was inverted in each one of these periods, the stock market behaved, relatively well. There was essentially a bull market in each one of these zones down here, a bull market on equities in each one of these zones down here up until it started to normalize again. Unfortunately, I think it's terrible. This is a very strong indication of a recession coming, which means lower valuations, less money getting thrown into the stock market because people don't have as much money and they tighten up with their investments and so on and so on and so on. But really, until it starts to correct again, there's no until the yield curve starts to correct again. The stock market can continue to go higher. So I have a bullish bias today, and probably until I see the yield curve invert again, and then I'll have a bearish bias. I think we're going into what's supposed to be a really bad earnings season. And we're just now kicking it off, so I could be completely wrong. I'll see how. Obviously, so as earnings get reported, my bias might change. But we'll see. The inflationary environment tends to be okay for earnings statements. So especially the S&P. Where the biggest and brightest and best are represented. The most profitable. The S&P has a certain amount of S&P 500 has a certain amount of criteria to satisfy in order to be included in the S&P 500, and that's and part of that is being able to weather the tough times. The S&P 500 companies that are included in it are supposed to be able to withstand the bad environments, bad economic environments. Some more so than others, of course, but like utilities, So there's going to be, and this is my personal opinion. Again, I could be wrong. I think there's going to be a rather significant run up in the S&P here until it shakes off enough people, until it shakes out enough people on the short side for Wall Street to start selling off again. So what looks to me could happen easily is for it to come back up and get, if not test new highs, get close to it and get close enough to it so that all the shorts are wrung out of the market, and all that money is sopped up. All right, everybody. Good luck out there. Keep your wrist tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.